How's it? It's Brendon here from Infinity Investments, and I figured a great time to do some videos and give you guys some updates on everything that's going on is while I'm sitting in traffic, because you know what else to do while you're sitting in traffic, and I hate traffic, so I might as well make it productive. I'm going to the US tomorrow. I'm so excited because I get to buy more property, and it's what I love doing. Love analyzing deals, love meeting with the partners, love getting to dig into some good quality deals, drive the properties, have a look at where we can add value. If we can add value, oftentimes we can't, and we simply don't buy. And really, I want to start doing some videos and sharing the journey with you guys and with anybody that really wants to learn and see how we're actively doing deals, and see that it's not as easy as every course makes out. You know, you go do a property course on a weekend and come out thinking you know how to buy property, and then you get into the real world when you start actually looking for them, analyzing them, trying to understand what the returns could be, and then you start dealing with some of the issues. Maybe you buy one and tenants start phoning you, or you have to place a tenant, and what kind of lease agreements do you need, and how do you protect yourself, and what are the laws, and how do you kick a tenant out when they're not paying, and all of this kind of stuff. And you go through the learning curve in reality, which a lot of times the reality versus the courses are not always aligned, you know. Don't get me wrong, you have to go do the education first, otherwise you don't even know what kind of questions to be asking. So you still have to do the courses. I'm not saying don't do the courses, but the courses give you some of the theory, and then you actually have to go and do something with that information and make it real. And in order to make it real, you have to have a live deal. You have to spend some of your own time and effort doing it. You have to maybe invest some money, and you have to know what kind of returns you're looking for and what your exit strategy is, and all the rest of the stuff that they teach you on these courses, and then live through it and actually do it and deal with the property and deal with a builder on a renovation and deal with some tenants and deal with some of the problems that go with property, because property is not always perfect. Most of the time it's dealing with shit, like literally termites, tenants, and and shit, because it's plumbing that generally breaks. So property management is a great business. Now, I love doing deals, and we hire great property managers that are really, really exceptional at managing property and managing people and actually sweating the asset, understanding how to manage the expenses so that we can get an outsized return. And one of the great lessons I learned was the shift from single residential homes to multifamily, or what we would call normal houses or cluster homes or townhouses or something like that, to blocks of flats or blocks of apartments. And I mean, if we think about some of this stuff logically, in the US at the moment, some of our good quality managers that are managing portfolios of single family homes, of just normal houses, they're charging between 8 and 10% of the revenue per year as management fees. And they charge a tenant placement fee of roughly 1 month's deposit and all the rest of that stuff, or at least a tenant management fee of 1 month of the rental. So you've got 1 month of the rental going out, and then you've got 8 to 10% of the revenue going out thereafter. My goodness, that's expensive. If you work that out in terms of their risk-reward ratio, they're taking 10% of the income of the property, and sometimes a little bit more than 10%. And how much risk have they laid out? Not very much. And they've got the admin staff to deal with and all the crap to deal with, but you're still paying for all the repairs, even if they're doing it. And oftentimes they're marking those repairs up as well. So if you are doing some management contracts, just make sure you are reading them carefully, and you look for how much their markup is on any stuff that they have to actually do for you. And then you look at hiring a really, really professional multifamily operator and how they run the system, and you're not going to pay them more than 3 to 3.5% of the revenue to run a full-on project with 200 or 300 units. And if you look at that difference and say, well, if I was spending 10% of my income on 300 homes compared to 10% of my income from 300 apartments, all of a sudden buying 300 apartments and actually only having to pay 3.5%, because that's the market rate to hire a great manager in the USA, for example. We do a lot of business in the USA, and that's my primary market that I want to keep building my wealth in, because it's in US dollars and not in rands. You know, all of a sudden there's a very big incentive. If you've got 300 units, let's say 300 houses versus 300 apartments, you've got an economy of scale where you've got a proper professional outfit that can manage 300 apartments. It's in one place. It's not spread out all over the place. You've got maybe 1 or 2 staff members that can do it. maybe 3 staff members. You've got a leasing agent, you've got a showing agent, you maybe got a superintendent, and maybe somebody doing some minor repairs on the property. But you can then manage those expenses a lot more carefully when it's in a multifamily project. It's one of the reasons I love multifamily. And if we also look at some of the global trends and see, well, millennials don't really want to own homes at this point in time. They want freedom, they want to be able to move around, they want to not commit to long-term stuff. They don't want to sign a 30-year mortgage, they want to sign a 12-month lease. So let's give it to them. Let's allow them to sign 12-month leases and rent from us. And if we can rent stuff out and manage our expenses and manage the management headaches related to property investment, and trust me, all the magic is actually in the management. It's actually in living with the property investment for 10 years, 20 years into the future, and saying, well, if I am going to live with this for 10 to 20 years, what headaches do I want? What headaches am I willing to live with? That was a loud motorcycle. Anyway, what headaches am I willing to live with every single day, and how much am I prepared to pay somebody else to live with those headaches? And if it's commensurate, then absolutely, a payment is a measure of appreciation. So we want to pay great money to good people, but we also want to make sure we're managing that money so we keep as much money as possible. Because in terms of growing wealth, there's 3 things we have to remember. 1, how to get the money, how to make the money, get it. 2, how to keep the money. And 3, how to duplicate that and do it again and again and again. So protect ourselves. So if we're going to keep the money, we want to grow the money. We want to make sure that we're in investments that grow for us. And I want to make sure that I don't have to think about these. I want the incentives aligned. I want to make sure the partners' incentives are aligned, that we're paying on an outcome, we're paying on a result, we're paying on performance, that I'm getting paid on performance. I don't want to get paid if I'm not performing. I want to make sure that my investors make money before I make money. That anybody that's partnering with me, that's putting their money alongside my money in a deal, is getting paid before I get paid. So that I know I've got to make sure I perform before I can get my money. That way we build some incentives in, and then I build that in terms of the deal negotiations behind the scenes. I build that into the way we structure the deal with everybody. In terms of our property managers on that side, we want them on a performance basis and with some incentives. On our sponsors that bring the deal and the debt, we want them on a performance basis. We want them on an outsized risk reward relationship where they might not be risking that much capital in the deal, but we want to make sure that if something goes wrong in the deal, they're still hurting, they're still on the line. Their balance sheet is on the line, their name is on the line, their integrity is on the line, and some cash on the line. So we want to make sure that they do have something in the game. I need to change lanes here so that I can get where I'm going. So let's pause this video for a second. Let's get this done without actually killing myself. There we go. So aligning incentives is so important, and the negotiations is not always with only the seller. The negotiations are with everybody in the deal. So we've got to make sure the US sponsor is aligned and his incentives are met. We've got to make sure our partners, in terms of the investment partners, the passive partners, the guys that are putting in some of the cash, that their incentives are met, that we've got some protections for the smaller investors, that people can still vote and have some control in the deal. Because if you can't have some control in the deal, you have no control on your own destiny. So we make sure we build those small investor protections into the voting systems. We make sure we control how much the manager can actually do, how much they can spend, how much they can loan against the property without calling for a vote, etc., etc. So we build those protection systems into every deal that we do, and we're building $1 billion portfolio in the next 10 years. We're at $134 million now. We've only been going for 2.5 years, and if I'd projected forward that, would we be at $134 million in 2.5 years, I would have said no, that's quite a ridiculous target. Yet, here we are. We have $134 million under management. And it's the learnings in what we were able to do there to build this portfolio. We're just duplicating it, and we're rolling it out again and again and again. We're buying medical buildings, and we're buying multifamily or developing multifamily. Either way, we want to be in those two trends for a bunch of different reasons. I love medical because medical is safe. It's, Doctors don't move. We've got the baby boomers. We've got something like the 10,000 people per day turning 65 in America. It's incredible. We've got one of the biggest populations living longer, that have money, that are going to be spending money on healthcare, and they have not been building enough healthcare real estate to service that demand. So we look for healthcare real estate where we can find an outsized return and create a little bit of value and just collect the income. So in terms of being able to get the money, keep the money, grow the money, we want to find the property that's going to give us the income so that we know we have income and we're safe. As long as we're collecting income, regular checks every month without fail, we'll be okay. Then the other sector is multifamily. For all the trends, the millennials don't want to sign long-term leases. We also have the millennials do want to sign long-term leases in terms of 12 to 24 months, but they don't want to sign a 30-year bond. They want freedom. And we've got the baby boomers as well that also want to downscale from the big house up north in the cold weather to a nice apartment down south where it's more tax friendly, easier to live with, and they can travel around and go on their golf tours, an easy lock up and go type of lifestyle, and they want to rent for a reasonable amount of money with great amenities where they don't have to think about mowing the lawn anymore, because strangely enough in the US you generally mow the lawn yourself, or you have your kids do it or something like that, but you don't have staff do it. We're quite spoiled in South Africa in terms of the people that we have to help us, the labor that we have here to help us in the middle income to upper income kind of brackets. And in the US, you do it yourself. So the baby boomers don't want to do that stuff themselves. They want somewhere where everything's taken care of. They've got a gym on site. They're close to great restaurants. They're close to the city center. They got it on a walking path or a bicycle path or something like that. They're in a nice apartment with good quality amenities in terms of the gym. What else can they have? Like one of the great ones I looked at recently had a wine cellar where you had your own little wine cellar with a little app that you could unlock the wine cellar with your cell phone. They had an incredible gym on site. They had a great restaurant on site. One of our properties that we're doing now in the States, the mill that we're converting to 303 apartments right now, that one we're going to have a brewery on site. We're going to have a little coffee shop on site. We're going to have a work play area where people can go and just rent a little space to do some work. So very much bring in the new age thinking of solopreneurs, travel entrepreneurs, guys that are building businesses from their laptops and just want a place with really good Wi-Fi, and where it's quiet, where they can kind of co-work and co-mingle with other people. We're building that into one of our properties that we're doing in Greenville in South Carolina. So we're doing that stuff already, and being a property investor properly, doing it properly, is hard. It's not easy. It's like, one of my great mentors said, success is your ability to bear pain. And in real estate, it really is true. It's how much are you willing to take? How much pain are you willing to take? But the upside's worth it. I mean, on these properties now, our internal rate of return is averaging 20 to 25%. Our cash on cash returns are coming in at 6, 7, 8%, sometimes even more. We've had properties producing more than that. So we can get a real cash flow going, and we've got some decent upside built into the pro formas and actually getting delivered in real life. It's a vastly different thing to, one of the sayings we have in the office is never believe the pro forma, because the pro formas always lie. I haven't seen one spreadsheet that ever tells the truth when it comes to property, because it's a snapshot of what we hope the future will look like when we're doing these pro formas. And reality always bites you in the ass. You have 303 tenants and 20 or 30 of them don't pay for whatever reason, and all of a sudden your cash flow is different, and the returns are not what you expected. So you've got to be able to manage that problem out, and that's a people management system. That's not a property problem, that's a people problem. Did you hire the right manager? Did they do the right marketing? Did they spend the right marketing? Did you build the right product? Did you have the right product when you bought it? Does it have the right feel? Is it in the right neighborhood? And I'm not so worried about neighborhood, because usually you you can adjust that through the financial engineering, but neighborhood does play a role in terms of type of tenant that you're trying to acquire. So are you spending the right marketing dollars to acquire the right tenants? Are you incentivizing them correctly? Are you structuring your leases correctly so that you can control the tenants to a certain degree? Are you leveraging different space in the property where you could maybe have some bicycle racks because you're on a bicycle path and there's space for them, or you've got some extra buildings at the back, like we've got at our mill. We've got some warehouse space at the back that we're going to convert to storage space, because storage is one of the major problems in the USA. So if we've got a great apartment with great amenities and we've got storage for the bicycle, the jet ski, the motorcycle, the skateboard, the tennis rackets, all the stuff that they would be dragging up and down stairs and elevators all the time, now we go and create a new product that gives us another line of revenue. And it's a small space, and it doesn't take us a lot of money to build those storage units, but all of a sudden we've got a really great revenue stream on that property with no real extra money laid out. Like, it's small money in terms of the outlay, but a really great return on investment, because we've got unused space. So what are the operators doing to unlock that value in those properties? And these are my thoughts that I'm going to share with you today. I'm almost out of the traffic, so I'm going to be home in a couple of minutes. And I just want to say that if you are a person that absolutely loves property investment, but you're a professional, you're great at what you do. You're maybe an entrepreneur who knows how to build your own business. You're a CEO, you're an executive, you know how to create money. You're an accountant and you know how to save money, or you're a doctor and you know how to fix people and save people's lives, but you don't have the time to go out and find great deals and do great deals. You maybe know how to do them, but you simply don't have the time to go out and be great at it and look at 100 deals and fly to America 4 times a year and analyze every deal and drive 1,000 miles in one trip to make sure that you see enough property. You got to kiss 100 frogs to find a prince. It's really that simple. And if you don't have that time, but you're looking for the right properties and the right partners who are actively doing that anyway, and you can put your money alongside us, and your money is treated exactly the same as our money. It's treated exactly the same as I would with my mother-in-law, with my sister-in-law, with my dad, with if the money's treated exactly the same, if that resonates with you and you really, really, really want to do great property deals and you're actively out there looking for them, but you don't have the time to really dig your heels in, then please send me a private message and say you're keen to follow what we're doing and learn from what we're doing, and maybe if a deal resonates with you, you can partner with us. But this is only for people that really understand property. Property is something that's amazing. I love the cash flow of it. I love driving the deals. I love analyzing the deals. I love the people that I tend to meet. I tend to meet great people who think like me and act like me and stuff. So I really, really love the space. But if you're not into that type of thing, then that's okay. Then really, you don't have to PM me. You don't have to follow what our progress is. You don't have to be interested in anything that we talk about or anything like that. So, and you definitely don't have to invest with us. So that's okay. There's enough for everybody to go around. I love it that we live in an abundant world with abundant opportunities, and there's space for everybody to play in their flow. And if this doesn't resonate with you, that's okay. But if it does resonate with you and you want to get involved in some great deals, and we're talking $5, $10, $15 million plus type of deals, we know how to find them, we know how to fund them, and we know how to get the right debt. 3.5%, 4%, 5% in the US is now what we're able to get, depending on the deal. We can sometimes get non-recourse debt. We in multifamily, for example, we're looking at getting some debt on our project now when we go from construction to permanent loan, where we're going to take debt from the HUD, basically. So it'll give us a 40-year debt with a 10-year fix. Now, if you think about the risk reward on that, if we can fix our debt at 4 to 4.5%, and I've got an 8% cash flow, all of a sudden, and I've got a small period of interest only while I'm waiting for some rental bumps over the next 2-3 years, then all of a sudden we've got a cash on cash return of 10, 11, 12%, and we know what we're going to pay for 10 years. That's amazing. And we got it at over a 40-year time period, so we got a low repayment over 40 years and a small interest only period. It means we're going to cash flow this thing at a hell of a pace, and it's going to be amazing. And cash flow is everything. So we know how to get that type of debt. We know how to find the right partners that qualify for that debt. We know how to, when we're building construction projects, how to find the right construction people that we can get a bonded contractor where we know what we're going to pay for the building, regardless of what happens in the market or regardless of what he delivers, because he's got an insurance policy over what he can deliver. So if we pro forma that we were going to build it for $20 million, and he agreed that he can build it for $20 million, and he goes over budget, his insurance company will pay the difference. So we know what we're going to pay to build out a project. We don't have that type of protection in South Africa. We don't have guaranteed price contracts in South Africa anymore because it's too volatile. We don't know what the rand dollar is going to do. We don't know what the kitchen fittings are going to cost in 10 or 20 years or 10 or 20 months time when you're pro formaing out the return. So by the time you get your approvals on a development in South Africa, the whole market's changed and you don't know what the hell you're going to pay for anything. So it's extremely dangerous doing a development in South Africa because of those risks, and yet guys are developing left, right and center regardless, because the growth in the market is there, that even though the prices have changed, the market has changed, and luckily, if they're lucky, the market's moved up while the prices have moved up, and they still have a saleable product even with the higher prices. In the US, because of the low inflation rate, we can get guaranteed price contracts, and then we know what we're going to pay. So all of these little things come into play, and I'm sharing all of these things openly. And if any of this stuff resonates with you and you want to invest alongside us, then just send me a private message and I'll keep you updated on the properties we're looking at, on how we're analyzing them, on what type of returns we can get from them, how much physical cash we're going to put in as a team. So when I say we're going to put it in as a team, that comes from Brendan's own bank account, comes from Kevin's bank account, comes from Jared's bank account, comes from Brian's bank account. So that's the 4 partners in Infinity, and we personally put our money in every single deal so that we're invested right alongside our investors. And you need to be either an accredited investor in the US or a sophisticated investor in South Africa, and you need to really, really love real estate. And then get hold of us, and maybe we can do something together. And if we don't, that's also cool. Just follow us. I'd love to learn from you. If you are doing any properties, please share with me what you're doing. I'd love to see what other people in South Africa are doing, especially if they're doing stuff outside of South Africa. I'd love to see how you're structuring your deals, how you're protecting yourself, and who knows, maybe there's opportunity for us to partner in a project as well. So take care, have a great day further, and onwards and upwards in your wealth creation and wealth preservation opportunities. Thanks for taking the time to watch this video, and I'll be posting up a few more. Take care, bye.